Let's now talk about interest rate swaps. This is really the star of the show. As we discussed in the first video, this derivative is the one that is most heavily traded, and for a good reason, as we'll see later on, right? Okay, so starting from the definition, an interest rate swap is really just a portfolio of the derivative we have just discussed in the previous videos, a forward rate agreement. So all the tools that we have developed will be very useful now and will allow us to understand these new derivatives, the interest rate swap, very easily. Okay, so more formally, this is again a contract between two counterparties. One counterparty agrees to pay fixed and the other counterparty agrees to pay floating, just like in a forward rate agreement. The only difference now is that with a single contract, we agree not on just one single payment, but on a series of payments, okay? The fixed rate will now be denoted by C, and the C comes from coupon because, as you already know, this will look like a fixed rate bond that would pay a coupon, so C comes from there. And the other leg, a floating rate bond, the other leg, which is paying a floating rate, will look like a floating rate bond, okay, as usual. Okay, so let's look at a simple example. So an interest rate swap with a notional of $10 million. There are two counterparties. One is a firm. Let's say that the firm pays a fixed coupon of 4%. The other counterparty, which is a bank, will pay the floating rate, which is the LIBOR 6-month rate. Payments happen every 6 months, okay? And then instead of doing this just once, the difference now is that we will do this many times. So we specify that the interest rate swap will last for 5 years, meaning that we will do this exchange of payments 5 times 2, so 10 times, okay? So the firm will have to pay to the bank the fixed rate. This rate is always quoted as an annual number, so this is 4% per year, but since there are payments every 6 months, the firm will have to pay 4 divided by 2 every 6 months, so 2% of the notional, 2% of the 10 million, right? What the other side pays is depending on the floating rate, which in this case is the LIBOR, okay? So for example, suppose that 6 months from now, the LIBOR fixes at 3.5%. At the end of the period, we compute the payments and find what is the net amount. Okay, so very quickly, this is the scheme of the swap. We have the firm and the bank. The firm is paying fixed every 6 months, 4% divided by 2 of the notional. The bank is paying the 6-month LIBOR over the same notional, okay? Again, this scenario that we're looking at was suppose that the LIBOR 6 months is here at this moment is 3.5%. This will imply that at the end of the period, we compute the net cash flow. So the cash flow to the firm, where the firm is paying fixed and receiving floating, is positive, the one that's coming in, the floating, 3.5, and negative, the fixed that is going out, which is 4%. Okay? So times the notional gives us a amount of $25,000. Negative, meaning that the money is going from the firm to the bank. Okay? Only this net amount is paid. Obviously, we don't make payments of these full amounts in both directions. We just compute the net amount, and just one side pays to the other that net amount. So in this case, the firm pays the bank this amount of money. Just like in a forward rate agreement, again, the difference being that this would continue going on in every other, in all the next periods of 6 months until at the end of the 5 years. All right. What's the application of an interest rate swap? These derivatives are very useful to transform assets or liabilities from fixed rate to floating rate or vice versa. Okay, So for example, suppose that a firm has arranged to borrow a given amount of money, 10 million, at the floating rate of of LIBOR plus some spread of 0.4%. So this is like a floating rate bond, right? For some reason, the firm no longer wants to be exposed to this risk of this floating rate and wants to have a known fixed rate. Right? Okay. So the firm could retire the bond, namely buy back all the bonds that they have issued, and then issue a new bond at the fixed rate. Okay. But that obviously has high transaction costs. So if the firm prefers to just make this change in a quicker way without paying the transaction costs, because maybe they foresee that they will want to reverse this transaction once interest rates go back to the levels that they want. So the alternative to retire and issue a new bond is to enter into an interest rate swap. So put a swap on top of the existing floating rate bond. Okay. So if the firm enters into the swap of the previous example, what will happen? So every 6 months, the cash flows that the firm will have will be the following. Well, let me show this with a scheme that is easier to see. Okay, so here we have the firm that has issued a bond. Okay, it is paying floating rate at the rate we defined before, LIBOR 6 months plus a spread, right? And what is the effect of adding an interest rate swap to this? The interest rate swap requires the firm to pay fixed this amount, and the firm receives the 6 months LIBOR, right? So the net result is that this LIBOR cancels with this LIBOR. So all that's left is fixed. The firm will pay a fixed rate of this amount, 4%, plus the little spread that still exists, right? So the net is 4 plus 0.4, that is 4.4% per year, or that divided by 2 every 6 months, right? So again, the swap is an easy way to transform a floating rate liability, in this case, into a fixed rate liability. It's quick to do, it's relatively cheap, and when the firm decides to cancel, it can very easily also close the swap and return back to the floating rate that it has. Okay.